always look to record it at the fair value of your asset that is given up. That is the first point, all right? If the fair value of the asset that is given up is not there, then you use the fair value of the asset that you receive, all right? Now, if both fair values are not available, all right, then you can use the carrying amount of the asset that is given up, right? And this also happens when the transaction lacks commercial substance. Let me explain commercial substance, and then we do an example with figures to actually illustrate this. Okay, so a non-monetary exchange of assets, so a barter transaction between assets, lacks commercial substance if it will not change the future cash flows in any way. So the timing of the cash flows is not affected, the amount of the cash flows that you're going to get is not affected, and the risks associated with the cash flows are not changed. So what does it mean? If you're changing one machine for another machine, it will not affect any future cash flows that you're receiving, okay? They'll remain exactly the same. So let us say your company, look at MTC. What are MTC's colors? What are the colors of MTC?
Blue and white.
Blue and white. All right. So assuming MTC has a red machine and then they want to exchange it for a blue machine, an identical blue machine, and they have another company that actually has a blue machine, let us assume. So then the two companies just swap, and MTC just wants the blue machine because it goes along with its colors. And since those two machines are identical, it's not going to change the cash flow, right? For MTC, it's not going to affect the risks, right, associated with the changing of the machine. The timing of the cash flows will not change, and the amount of the cash flows will not change because the machine is basically exactly the same. It doesn't affect the cash flows. All right. Also, when there won't be a change in the value of the operation that the asset is used to, so it won't increase the value of your operation because you get that machine, right? Or it won't decrease the value of your operation once you get that machine or once you exchange the asset. And also, any expected change in cash flows or value is insignificant relative to the value of assets exchanged. So there might be a change in cash flows, but it's very insignificant. It won't make a material difference. If any of this happens, then we say that that transaction lacks commercial substance. All right. So when a transaction lacks commercial substance, then you're going to use the carrying amount of the asset given up. So let us look at examples. This is on page 367 in Gripping Up. It might be 368. I actually now have the 2022 edition, but I'll use the previous edition. So it might be page 368 of Gripping Up. Gripping Up is very important. Please make sure you have a textbook. You cannot rely on a study guide. You cannot rely on slides because the book goes into so much detail, and you don't only use it this year, you'll also use it next year as well, and in future if you want to do postgraduate studies. So buy that book. It's a worthy investment. I don't know how much it costs. It's quite expensive, but failing is also expensive, right? So you rather make rather buy the book, then you have to pay to repeat the course. All right. So just weigh which is more important. So so we have 3 scenarios which relates to the same transaction. It says Don Limited exchanged a machine for a vehicle. So the machine is the asset given up, and the vehicle is the asset that is acquired. Are we clear up to there? Are we clear?
Yes, sir.
Okay. So they exchange a machine, so they give up a machine for a vehicle. Now we're given the machine carrying amount is 10,000. So that's the carrying amount for all scenarios. Scenario A, B, and C doesn't change. And the cost price is 18,000. So if the carrying amount is 10,000 and the cost was 18,000, what is the accumulated depreciation on this machine? What is the accumulated depreciation on the machine?
8,000.
Accumulated depreciation is 8,000. So you remember accumulated depreciation is just cost. The carrying amount is just cost minus accumulated depreciation. So we can clearly see that accumulated depreciation is 8,000. So we're given the fair value of the machine is 11,000, and then it gives us, we have to go to point number one. So point number one tells us the difference in fair values is considered to be immaterial. The difference in fair values is considered to be immaterial, all right? While the fair value of the vehicle is 12,000. Now going back to the notes, having this transaction, at what value will you record the vehicle? At what value will the vehicle be recorded in the books of Dawn Limited? Because Dawn Limited is the acquiring entity. At what value will the vehicle be recorded in Dawn's books? Let me go back to this.
15,000.
15,000.
Yes, sir.
Look at this slide. So before you do calculations, you always have to go back to the theory. All right, you always have to go back to the theory. And the theory tells us when you have a non-monetary exchange of assets, first you look at the fair value. So the asset that you receive must be recorded at the fair value of the asset that is given up. That is your starting point. Or if you don't have the fair value of the asset given up, you're going to use the fair value of the asset received. All right. So now I go back to the question again. At what value will you record the vehicle?
Sam? Sam? Sam?
Oh, apologies. My mic was muted. All right. So I see Alpha Dube says 11,000. Tavi Orerua also says 11,000. Okay. So that is the
Sir,
starting.
I'm saying 10,000.
You're saying 10,000. Who's that? Dewana. Dewana says
Yes, sir.
10,000. All right. So let us look at the theory. Does the theory tell us that? Oh, so you are using the carrying amount. When to use carrying amount? Carrying amount? Carrying amount will be used. Carrying amount will only be used if the transaction lacks commercial substance, or if the fair values cannot be reliably measured. So we cannot use the carrying amount, all right, because the question gives us fair values. So the fair values are actually known, all right? So that is why we cannot use the carrying amount of 10,000 to record the value of the vehicle. So the starting point is to use the fair value of the asset given up. And the fair value of the machine is 11,000, although its carrying amount is only 10,000. All right. So when the vehicle comes into the business, we are going to have to record the vehicle at the fair value of the machine, which is 11,000. Okay. So we're going to debit our vehicle with 11,000, although the fair value of the vehicle in the books of the other company is actually 12,000. Okay. Then you're going to credit the carrying amount, which is 10,000. Okay, so you can't just do a one journal entry where you credit the carrying amount, or you can do it in detail, whereby you're going to credit the cost and debit accumulated depreciation. This is what the approach. This is the approach that Gripping Cup takes. Let me actually open so that I do not confuse you. I will share my. Let me reshare my screen. Okay. So you can see my whole screen, right?
Yes, sir. Yes, sir.
Okay, it seems, okay. So we said we're going to debit the vehicle, going to debit the vehicle at the fair value of the asset given up, which is the machine, and the fair value of the asset given up was 11,000, right? Then we're going to have to credit the machine. So we're removing the machine from the books. So how do you remove the machine? So a machine is an asset. It would have been recorded on the debit side. So you would have debited the machine at its cost price, initial recognition. But now that we're removing it, we have to credit it. So we credit the machine at its cost price. Okay. Since we've gotten rid of the machine, we also have to get rid of the accumulated depreciation that relates to that machine, right? And accumulated depreciation, what type of element is accumulated depreciation? Anyone? What type of element is accumulated depreciation? Assets, liabilities, income, expenses, equity. What type of element is accumulated depreciation? Is there anything there in the chat?
Yeah.
Pardon? What is it? Have you forgotten? The accumulated depreciation account works with the asset account. So it's a negative asset. So if you're crediting an asset, yeah, so it's a negative asset or just a contra asset. So if you're crediting an asset, then you have to debit the accumulated depreciation on the machine. And we calculated the accumulated depreciation by taking the cost minus the carrying amount, which were given as 10,000. Then we got an amount of 8,000. The accumulated depreciation is 8,000. Now, when you prepare journals, what does accounting say? What needs to happen to your journals? What needs to happen with your journals?
Your debit should equal your credit.
Your debits must equal your credits. But if you look at this, the debit side is more than the credit side. So it means there's a certain amount that must come onto the credit side. So we know that amount is 1,000 because the debit side equals 19,000, but the credit side only equals 18,000. So what is the difference in 1,000? What is the difference? What type of elements are credited? What type of elements are credited? Income?
Income and liabilities.
Income, equity, and liabilities. So then what is the 1,000 then? Is it a liability? Do we owe it to someone? What is the 1,000? Is it a liability? Is it equity or is it income? What is it? The 1,000? This 1,000, what element
It's
do you have?
income.
It's income. So yes, it's income. Why is it income? This is
because they made like a profit.
They made a profit on the exchange, right? This is the profit. That is the profit on your exchange. They made a profit, okay? So that's your profit on exchange of assets. And you can easily look at the profits easily. Let me show you. So profit appears in the statement of profit or loss. It's an income. Okay. Machine is an asset to appear in the statement of financial position. This is S&P, statement of financial position. That is a contra asset or a negative asset appears in the statement of financial position, and a vehicle is an asset appears in the statement of financial position. The reason we can actually look at this and easily determine that we made a profit, let's just go back to the question without even having to do those calculations. Look at this here. We're given the fair value of the vehicle is 12,000, while the fair value of the machine is 11,000. And we are told that the vehicle must be recorded at the fair value of the machine. So we are receiving the vehicle that we're receiving is valued more than as a fair value more than the machine that we're receiving. So in this instance, we're going to make a profit. So you can, yes, okay, let me just finish. So we can easily see saying 12,000 minus 11,000, you've already made a profit on the exchange. Okay, you can ask your question.
So why are you considering the fair value if it says that it's considered immaterial?
The difference of fair values is considered immaterial. So it's not really going to be big, but we're going back to the theory. It tells us that a non-monetary exchange of assets must be recorded at fair value, firstly, of the asset given up, right? So you must record the asset that you receive at the fair value of the asset given up, or the fair value of the asset received, if that is more clear. In this instance, we have both fair values. We have fair values for both the asset given up and the asset received. So the difference between the 12,000 and 1,000 is immaterial. It means it's not really going to cause a change in the cash flows or anything like that. It's not really going to cause like a huge change in the value of the business. All right, it's not going to significantly impact on decision making. All right, because it's immaterial. Is that clear? That's just what it means. It's not, remember, something that is material will cause a user to change their decisions, but this one is immaterial, so a user will not change any decisions that they're going to make based on the difference between the 12,000 and the 11,000. Are we okay with that one?
Yes, sir.
Okay, now let us do scenario B. Scenario B, again, the same thing. We have a fair value of the machine and the fair value of the vehicle. But scenario B tells us to look at bullet number 2 or point number 2. It tells us the difference in fair values is considered to be material. So it's significant, right? And the fair value of the vehicle is more clearly evident than that of the machine. The fair value of the vehicle is more evident than that of the machine. Now, what happens here? We're getting rid of a machine with a fair value of 11,000 for a vehicle with a fair value of 15,000. What happens here? Almost up. Sorry, just going back to the previous one, I said we compare the 12,000 against the 11,000. And that was actually incorrect. We compared the 11,000, the carrying amount of the fair value of the machine against its carrying amount. So the carrying amount was 10,000, but we recorded the vehicle at 11,000. So we compare the carrying amount against the value that we're going to use. So we compare the 10,000 against the 11,000 to determine the profit. So in the same way, in this instance, for scenario B, we're going to use the fair value of the vehicle. And the reason we use the fair value of the vehicle is because the question tells us it's more clearly evident, and the theory tells us that if the asset received has a fair value that is more clearly evidence, then you have to use that fair value. So we're going to record the vehicle at its fair value of, 15,000. All right, because it's more clearly evident than the fair value of the machine, which is 11,000. So in this instance, you compare the fair value of the vehicle, 15,000, against the carrying amount of the machine, 10,000. In this instance, you're going to make a profit of 5,000 for scenario B. So the journals will remain exactly the same. Let me actually do it here in Excel. Let's go back. This remains exactly the same for scenario B. I'm just finishing with this and then I'll end the class for today. So the vehicle will be recorded at its fair value of 15,000 because that is more clearly evidenced. Okay. We again debit accumulated depreciation to get rid of the accumulated depreciation. Credit the cost price of the machine to get rid of the cost price of the machine. So we're actually getting rid of the carrying amount of the machine, which is 10,000. And now what is the difference between the two? The difference between 18,000 and 23,000 is 5,000. So you made 5,000 profit on exchange of these assets. Why? Because the carrying amount of the machine was 10,000, but you received a vehicle worth 15,000. Okay, so we're going to end here for today. Please read, do scenario C, go through the rest of the slides and start with part 2 of the slides on PPE, and we'll continue next week. I will put a link to a WhatsApp group. I'll put it on Teams, so you can just click on that link to join the WhatsApp group for financial accounting 201. And please enroll yourself on e-learning. The course code is FAC 611S. All right, the course code is FAC 611S. I will see you then on Monday.